Hi, my name's Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's jump straight in today's Q&A episode. First question is from Tony. Tony writes, will super contribution scheme designed to reduce the taxable component of super contributions be subject to the future budgetary hatchet jobs? Having a brief AI tool indicates there could be 5 to 10 billion a year collected in super death benefit tax, of which 2 to 5 billion could potentially be avoided through recontribution strategies. Would like to hear your opinion without giving the government any ideas. Okay, so what Tony's question relates to is what we tend to call a recontribution strategy, which means withdrawing money from super and recontributing it as a non-concessional contribution, because that goes through to your tax-free component, as opposed to your taxable component is anything that's accumulated using concessional contributions and any earnings that are being concessionally taxed, so taxed at 15%. And so it's a strategy we've talked about here. I think Campbell did an episode on it, actually. Yes, he did. Just looked it up. Episode 376. So there's been some talk about that, and there's been talk about inheritance taxes, and I guess there's been some criticism with the capital gains tax in terms of, a spouse passing away and resetting a cost base that then falls into the new regime. All those sorts of things, there's been those criticisms. I think the government has drafted legislation to avoid situations like that. Well, it has. There's draft legislation out there. But there's been no real talk about sort of closing this loophole. But I mean, it'd be very tempting, right, to do that for the government to raise revenue, which means that, you probably should, if you're in the situation where you can do a recontribution strategy, and it really only is appropriate for people that between 60 and 65 that are retired, or anyone over 65 and they're under the transfer balance cap, they can probably do a recontribution strategy. Not advice, of course, information only. So take advantage of it. Of course, the other way to get around paying the super death tax, as people call it, which means that if on your taxable component, your beneficiaries, if they are not financially dependent or interdependent on you, will pay 17% top up tax. So, look, it's not the end of the world, but it's, the argument is that super is there to fund your retirement, not necessarily your kids' retirement. And so by paying 17% top up tax, it means they're paid 32% or 30% plus the Medicare levy. Still not the 47%. So it's not terrible, but, people for some reason get a bit upset about it. I think, my personal view is I think it should be closed. And I know that's ridiculous for me to say because, it's not in favor of my clients. But if we go back to super and make sure super is being used for what it's supposed to be used for, not as a tax haven, not as a way of accumulating wealth to then pass down through inheritances to kids or family members, that's not its purpose. Its purpose is to fund my retirement. So the more that we can use and tighten the rules around super to use it in the way it's supposed to be used, the more efficient it will be and the less chance the government has or reason to play with it. And so I think things like, there shouldn't be any contribution tax if your balance is under a certain amount, because really, in terms of compounding capital growth, actually what we want to do is we want capital markets to fund all our retirement. So that is, get our capital into the share market and let that do all the heavy lifting in terms of funding our retirement. That benefits me as an individual retiree, and it also benefits Australia as a country because there's less burden. So the best way then to achieve that is let's get people's balances as high as possible, as fast as possible. So therefore, maybe for the first, 200,000 of contributions, not balance, but contributions, maybe they should be tax-free, so you don't pay the 15% tax. And then once you're at 200, then pay the 15% tax. Those sorts of approaches, so close the recontribution strategy, which is typically used by people that feel like they're already going to have surplus money. So they're using super or looking at super as a mechanism to fund inheritance through. So close that loophole and then, redesign the tax system so that it really encourages younger people to build a balance faster. Anyway, I'll get off my soapbox. Just wanted to answer that question. I think it is ripe for, tinkering by current or future governments. So it's something that I wouldn't sit back and just assume it's all a recontribution strategy is always going to be available. But I don't think it's on their radar at this stage. And it is certainly, it's certainly worthwhile looking at if you're in the position to be able to do that. And as I said, just go back and have a look at that previous episode that Campbell did. Thanks, Tony. Thanks for your question. Not sure my answer was what you're really looking for, but anyway, worth sharing in any case. Okay, next question is from a listener that wants to remain anonymous. And he writes, I found your podcast a few years ago and listened to almost every episode. Now, there was an episode where I listened in the early days where you mentioned some of the mistakes you've made along the way and things that you might have done differently. Hearing you talk openly about mistakes gave me the confidence to listen and trust to your views on investment. Thanks for the time you take to put into this podcast. That's really interesting to get that feedback. I guess, talking about our mistakes, I guess can sort of build some rapport or break down the walls to sort of say, well, not everyone gets it right. I've certainly made plenty of mistakes. I've made heaps of mistakes in business too. Like that list is really long in terms of running your own business. And Mina and I are pretty close to finishing a book that'll come out next year about that. And then I'm done. I'm definitely not going to write any more books. And anyway, it's kind of interesting. Maybe I should talk more about mistakes as much as I talk about how to get it right. That's kind of some interesting feedback. That's why I like these Q&A sessions, because I get to sort of, it's not just a one-way conversation. I get to kind of learn about what you're thinking. So, if you find bits and pieces valuable and you're going to send in a question, please share that information. It's always very useful to me because, as I said, to design this content, in some ways I like to, ignore the suggestions and build something that I want to build. But also I like to know, if something's really resonating. So thanks to that listener for sharing that feedback. Okay, here's a quick rundown of the stats. He's 37, 320,000 in super, pretty good balance for a 37-year-old. Business profit $110,000 a year, wage from business 45. So total income's about 155,000. Partner female, not relevant, 35. Super 190. Stable corporate job 135,000 a year. Home in rural Victoria worth about 320, completely paid off, which is fantastic. 50,000 of shares, all Vanguard ETFs, and 300,000 in cash that was from an investment property sale and inheritance. Financial goal is to have $120,000 a year perpetual portfolio, reducing working hours in mid-50s. It's clear to us that it's a very important time in our lives to make the correct financial decisions. In my mind, we've got two options. Option one, use a buyer's agent to buy a small house in inner city Melbourne for maximum value of 1.2 and plan to hold it for long term. We plan on using Kate Bakos. I hope we've made the right decision. She's a buyer's agent. Option two, aggressively save and invest into ETFs and super. We will get professional advice to help us with this as well. It feels like a crossroad made more difficult by the recent budget. If you're in our situation, what would you do? Any insights would be really appreciated. Okay, so I'm building a bit of a library, as you can see, of episodes interrogating these changes with respect to property. And I think it's really important to say at the outset, I've said this a number of times, and I probably can't say it too much, but we're asset class agnostic. So it's not like I'm trying to find a way to make property work, just really interrogating it fully before we completely discount it. On the 5th of the 8th, I record a podcast, Can Anything Make Investing in property more attractive? So that was episode 430. And in that episode, I sort of looked at a few different levers you can pull, like high yield, less gearing, using entity, these sorts of things. And the conclusion that I reached kind of in that one was that a high yield can offset the drag on internal rate of return. So if the gross yield gets to, I think I said 5.3 to 5.5%, sort of, let's call it 5 to 5.5%, you start to get close to the same sort of mathematics as used to be the case when yields were much lower and historically much lower. Last week I talked about the growth cycle, the 20-year growth cycle, and maybe that's to blame for poor returns in Melbourne not necessarily just the government. Remembering that, land tax revenue raised by New South Wales and Queensland is pretty substantial too. And their reliance on property taxes isn't that much different to Victoria. So that's really encouraging people to really think carefully about cycles, growth cycles, and maybe positioning, Melbourne on the cusp of a growth cycle. And tomorrow I'm going to talk about potentially a cash flow strategy that you could use to certainly help with investing as well, subject to borrowing capacity and, your personal situation and these sorts of things. So as you can see, as I sort of work away and pick away at this, I'm sort of saying, well, there's going to be sectors, and there are sectors that are offering higher rental yields today than what they have done historically. Those rental yields, those purchase rental yields are likely to improve as property values fall and rental income in dollar terms rises, which I think we all expect that to happen over the coming weeks and months. To what extent is unknown, of course, but we expect some sort of movement in that direction that's going to increase the rental yield. So maybe, if we say rental yields at 4.5% for some sectors like a 2-bedroom apartment or villa unit at the moment, maybe conceivably, over the next 6 months, they might get to 5%, and that starts to look pretty attractive. And then if we say, okay, we're buying, after a 10 to 13 year flat cycle, then we know that we're likely to expect higher than average growth over the next 10 years. So instead of getting 6, you might get 9%. And if you hold for 30 years, instead of getting 6, you might get 7% because of that initial spurt of capital growth in the initial term. Put those two things together, higher starting yield and higher growth, the numbers can start to work from an investment property perspective. There's no rush. I don't think we're there yet. I think values will fall further. I think rents will rise further as well. But if we then enter into the market and then, let's say in 2 years' time, and I've expressed an opinion, I think on this podcast and as a guest on other podcasts, I recently appeared on the Property Couch podcast where I talked about this in depth, that 75% of voters are 35 years and older. Anyone in their mid-30s have probably put a lot of their financial resources into property, be it their home or investment properties, on the basis that the settings hadn't changed for many decades. And so they felt like, safe as houses, if you like. And so I don't think that's going to upset that cohort, which is 75% of voters. And then for the voters that want to get into the market, they're going to be paying higher rent. So that stops their ability to kind of save money for a deposit to get into the market. And who wants to buy into a property market when prices are falling either? So, it doesn't necessarily, I don't think it's going to move the dial in terms of home ownership. So it's possible that if you buy into a market, higher rental yields, higher future capital growth, and then you ascribe some probability, whether that's 10% or 50 or 80%, who knows, that's up to you, some probability that negative gearing might be reinstated in the 28 calendar year when we have the next federal election. You could look back on 26, 27 as kind of a year that provided a lot of opportunity. Now, having said all that for this listener, and I'm going to circle back to sort of say what I would do. But having said all that for this listener, one thing that they hadn't, they compared option 1, which is go and buy an investment property. Option 2, go and aggressively save and invest in the share market. So one is geared, one is ungeared. What you could do is say, well, option 2, let's include some gearing, at least in the initial periods as well. You're sort of 37, 35, 37. So you could gear progressively for the next few years just to get some gearing and increase the amount you're investing. So I think that would draw the two a bit closer together. And mathematically, we should point out that you're probably, if we're just only interested in maximizing wealth, a share strategy is going to beat a property strategy, probably. And certainly if negative gearing is never reinstated, then it's absolute. A share strategy is going to. So you've got plenty of equity in your home, go and borrow a huge whack of money and put it in the share market. Now, not a lot of people want to do that. Not a lot of people will feel comfortable doing that. But I just want to point that out because we are asset class agnostic. It's really important to point out mathematically, evidence-based, using the evidence-based approach, which approach is likely to be superior given current taxation settings, borrowing to invest in the share market almost every day of the week. And it gives you flexibility around liquidity, these sorts of things. It's certainly better but not everyone's going to feel comfortable doing it, and not everyone's going to feel comfortable borrowing to that extent as you would with property into the share market. So what would I do if I was in this listener's position? And there's going to be many people like him. Well, and this is important. This is not advice. This is my opinion, and I'm one person, and it's entirely possible I'm completely wrong. So I say that it sounds like a silly thing to say, but I say that. I mean, it's important to point out, of course. But I feel quite strongly that the current tax settings won't be here forever, because I just think it makes a whole lot of people poorer. About 60-70% of Australians own a home outright or with a mortgage. They're going to be poorer. They are poorer today than what they were in May. That's not going to make people happy. And then there's a bunch of renters that might potentially buy a property down the track. That could be somewhere between 10 and 20% of Australians. And then there's renters that will never buy a property or don't want to buy a property, have no inclination to do so. They're poorer too because rents are rising. So we're making, maybe 60 to 80% of Australians poorer, so we can help the 10% into the property market. But maybe there's other ways to help that 10% into the property market without making everyone else poorer. And, I think that's going to come to bear. So my view is, I have quite a strong view that these tax settings will change. Well, certainly won't be, maybe negative gearing isn't completely reinstated. Maybe it's capped, which I think is probably a good idea, either in dollar term or number of properties or something like that. So maybe it's not going to go back to, holders bowlers exactly where it was, but I think it will be reinstated to some extent. And because I have that view, and because my answer to this question, to this listener's question before budget night would have been go and buy a property, because the whole idea around, wealth by design, Investopoly was reduce the drag. So investment efficiency is the second element of the wealth equation, surplus cash flow multiplied by investment efficiency multiplied by time. And the investment efficiency around investment property is very significant. You had negative gearing and most of your return in compounding capital growth. So there was no tax drag. There was actually a positive tax contribution, and you made one decision. And as long as you nail that decision, you didn't need to make any future decisions. Whereas with building out a ETF portfolio, you've got to, each time you make a contribution, capital contribution, you've got to decide how to invest it and how to manage that portfolio over time. So my answer to this listener's question pre-budget would have been go and buy a property. My answer to this listener's question post-budget, I think, is still go and buy a property, but only if you agree with what I'm saying. So this is not advice, it's very much an outlook. But it's important to point out that it's based purely on current settings. Mathematically looking at it, it's an inferior strategy compared to shares. So I would test, if I was talking to this person, I'd really test their comfort levels and their own personal desires. But if they said to me, look, I'm comfortable to go and borrow, $750,000 and invest that $750,000 over the next 2 years into the share market, and I'm completely fine with that, then I'd probably, if I was working with that client, that's what I would do with them, because I'm managing the ETF portfolio, so I don't need to worry about that in terms of I've got confidence that's going to be done correctly, and mathematically it's going to be the best thing, and there's no legislative risk either with the strategy. Whereas go and buy a property, you're not necessarily buying on the premise that negative gearing is going to be reinstated, but you're adding, I certainly am, adding some weight to that decision. Look, I've prattled on for a while, but it is an important one. It's something, keep listening to the podcast. I share my thinking as it arises and my analysis. So as I said, in August, I've done at least 3 episodes on property. And I will do more. I'm not too worried about, hitting you with too many episodes all about property. If there's something intelligent, or I feel like it's intelligent to share, I'll certainly do it in this pod. So keep listening, but I think I'd be inclined to go in that direction. And Kate Bakos is a wonderful buyer's agent. I would have full confidence in using her. I think that's the right decision. And there's some other great buyer's agents in Melbourne, I should say. She's not the only one, but choosing the right person is critically important because it's going to help you make a good decision. So anyway, I wanted to spend a bit of time on answering this question today because it's such an important one, and because I think there's lots of listeners out there that are probably in a similar situation. As I said, there's no rush with this decision. You might decide, look, let's see what happens over the next 6 months. But I think if you're blind to the opportunity, you'll never see it. Whereas if you are open to the opportunity of investing in property and market conditions improve from an investment standpoint, improve between now and say in 6 months' time, and you're looking for it, then you'll see the opportunity. I just wonder if in the future we'll look back at calendar year 25 and calendar year 27 and think there was a great opportunity there for long-term investors. I'm not saying there is, but anyway, I think I've made my views clear. So thanks to the listener. Thanks for the question, and hopefully that's helpful, and keep listening to the podcast. And by the way, the other thing I should say is please share. I was speaking to one of our mortgage brokers the other day, and she was telling me that she spoke to one of our clients, and that client said that his mate just went and bought 2 house and land packages. And we both sort of shook our head crazy. So the other thing I can ask, and this is, yes, the reason I'm asking you this is not self-motivated, but I acknowledge there's some self-interest here. But please share the podcast. Share this episode, in fact, in terms of our thinking. Share the 3 episodes that I've done in August, the one tomorrow as well. The more we can help people navigate and avoid the property spruikers, and that's what I'm most concerned about is property spruikers, the better off we are. So the other thing I'm thinking about is what opportunities were there in 26, 27 that we'll look back upon in 10 years from now and, recognize, but also how did this podcast help people navigate through these changes? What I would hate is people to go and buy shit property, get sold, poor strategies, buy into overheated commercial property market, do any of these sorts of things, and then look back and go, actually, I reacted in 26, 27 in exactly the wrong way. That has cost me, lost time, and time is obviously a necessary ingredient in building wealth. So if you do come across anyone that's sort of thinking about doing anything different or might look like they're being sold a story, please educate them or try and educate them using this podcast. And there's lots of other great resources and podcasts out there, of course. But please do share, because the more people we can help make good quality decisions over the next couple of years, good quality long-term decisions, the better off we'll all be. So I'll get off my soapbox now. Okay, let's change gears now. Next question is from Tom. Tom, a little bit about myself. I'm 36. My partner is 32. Combined incomes of 360. We've got 7 properties. 5 investment properties outside super, 1 inside super in our home. Properties in locations like Gladstone, Townsville, Latrobe Valley in Victoria, which is subdividable, looking to build a townhouse on it. Portfolios were 3.6 with 2.2 mil worth of debt. I've only recently started investing in ETFs, $1,000 per month, split between VAS, IVV, IEU, EMKT. My goal is to retire as early as possible or significantly cut down work. My questions are, should we continue to buy property as we have equity to do so and we've had good success? Are my ETF choices on the right track? Should I sell some properties and buy the ETF portfolio? Is it a good idea to invest in ETFs such as VGS inside my self-managed super fund as it's only holding property at the moment? Thanks, Tom. Well, where do I start? This is a really good one, because I did an episode last year, I think it was, that don't extrapolate the last 5 years of data, and now it's probably last 7 years of data, which we've had, that COVID period, that initial sort of COVID period. We've had tightening of borrowing capacity, higher interest rates, much higher interest rates than the previous decade prior to COVID, like double, twice as high. Cash rate, the time weighted average cash rate was like 2%, and now the time weighted average cash rate's like 4%. So that's what I'm saying, sort of double the rate or double the cash rate at least. And that pushed, a lot of people into more affordable markets and more affordable sectors. So Tom, congratulations. I mean, the first thing about investing is taking action and making decisions and putting plans into action. So I don't want to attack you for doing that. Well done. And you've made some money. So you're off to the races. It's fantastic. But what you need to really decide, was your strategy repeatable, and will it consistently build wealth over the next 2 or 3 decades? Remember, you're 36. You are investing for early retirement, hopefully, as you said, in your 50s. Actually said as possible, so you want to be retired as early as possible, but you also, the longer you're retired, the more money you're going to need. So you want a perpetual portfolio as well. You want to make sure that you're investing not only for your 50s today, but you're investing for your 60s, 70s. So your time horizon is really long. So therefore, your approach to investing in property in those locations, do you really think it's something that's going to work over multi-decade periods of time? Or do you think your recent results have been more as a result of being in the right time, right place and good luck rather than design? That's what I'd invite you to think. Of course, it's a loaded question, right? You know what I think. You've been right time, right place, which is fantastic, which is awesome, but don't think that what got you here will get you there, which is a book by Marshall Goldsmith, which is a great author. Anyway, so look, that's the first thing that you want to think about. I mean, if you've got your own 6 properties plus your home, you don't need more property. No way. I mean, assuming the property is good and it's going to generate good returns, you definitely don't need more property. In fact, you probably don't need anything other than wait another decade. As I said, though, I suspect that the big proviso there is if it's going to work, it's going to work in your favour. So I just don't think it will. I think regional markets have seen a significant uplift in value. I think there's no supply-demand fundamentals in a place like Latrobe Valley. Townsville, I wrote about Townsville. Actually, I wrote about Cairns in the last year or so. What I did is I shared a story that when I started Pro Solution in 2002, between 2002 and 2004, I'm not going to get these years perfectly right. Cairns went nuts. People were buying really high starting yields, like 5% rental yields were. And that's just because maybe the property was intrinsically undervalued. But people were saying, look, you can go and buy. It's almost positive cash flow. And then what happened is there's a lot of investor activity. Prices went nuts. And then really between '04 and like 24, like for 20 years, it really did nothing. And then it had another burst. Townsville's like that. A lot of these locations are very much like that. And that's how property does behave. But the average growth over that time is poor. So even if you think you captured that growth cycle or captured the growth cycle back in '02 and captured the more recent growth cycle, still on average, the return is low. And it makes sense, right? It's all about imbalance between supply and demand. There's no imbalance between supply and demand in the Latrobe Valley. I'd rather stick pins in my eyes than invest in that location. And to subdivide, which is really, subdivision is worthwhile when what you're doing is making a product more affordable. Because what you're doing is, instead of being able to afford a family home on a large block of land, what you're doing is subdividing and then building a townhouse or smaller house so that you're making that parcel more affordable. It's a little bit like what happens in stock markets when a company does a share split. If for those direct share investors, if you make it share more affordable, it's exactly the thing that Berkshire Hathaway, Warren Buffett's company, hasn't done, probably for good reason. But that's one of the ideas is if you do a share split, you increase liquidity. So why would you want to add more capital to an asset in a location that's terrible from an investment perspective? It might be a nice location to live in, but terrible from an investment perspective. So no to the subdivision, no to buying more property. Should you sell property and invest in ETFs? Well, I can't tell you what to do there. I don't know the properties. You give me broad indication of locations. It doesn't sound great to me. But should you sell them all or some of them? I don't know. You're going to need to get some advice on that. I think it would probably have merit, but you've got to really think about long term. You want to still have some gearing. It might be just reallocating that borrowing capacity. Remember, I did an episode the last couple of years about borrowing capacity is a scarce resource. It's not property. So how are you allocating that scarce resource? And I talked about return on borrowing capacity as kind of a measure. Do I like your ETF choices? VAS, no. I wouldn't invest in the Australian market. I certainly wouldn't invest in, well, not certainly, I shouldn't say it that strongly, but if I'm going to invest in the Australian market, I'd probably use QOZ. Yeah, QOZ, which is a beta shares fundamental indexing product, or I'd use a dimensional ETF to invest, so it's a value overlay, but I wouldn't use a traditional market cap indexing product like VAS, and I'm not that keen to invest in the Australian market. You've got IVV in there, which is S&P 500 market cap weight. No, I wouldn't do that either. If you wanted some direct US exposure, you might go an equal weight, so QUS. But I think you'd probably better off going a global value. So that could be VVLU or VLUE or one of the dimensional, they've got a global core value fund. I think it's actually called Global Core. Anyway, I can't remember the ticker code for that one, but I'd go sort of value. IEU, which I think is Vanguard's European fund. I like that. And EMKT I love as a emerging market investment. So I would certainly tinker with the portfolio. I've written about constructing an ETF portfolio. So Tom, I think you should probably go back and have a look at that episode. Oh, that was in April this year, episode 405. Have a look at that because I think that answers your question. Also, for those that have bought Wealth by Design, one of the prompts in the prompt pack that you can use, because what I've got is an AI companion tool which uses Google's Notebook LM. And then what you can do is you can get it to write you a prompt that you can then use in Gemini, ChatGPT, Claude, whichever you prefer, to review your ETF portfolio to make some suggestions. Now, it's only going to be information. It's not personal advice, but I think it could get you a long way to answering questions like these. And the final of Tom's question is, should he invest in VGS inside his super fund because all it's got is property? Yes, absolutely build out some liquidity in your super fund, build out some diversification in your super fund. Probably wouldn't do VGS. As I said, I'd use a dimensional, one of the value ETFs that I spoke about. But certainly I would go probably all global, all growth, using one of those sort of value ETFs. As you start building up portfolio, you can then introduce maybe traditional market cap indexing via VGS. But at least initially, my initial investments are going to be to the sectors of the market that exhibit the best returns. So really, quality first, use a great index. Secondly, then price. And then thirdly, then diversification. So that's why I would start with, the indexes that the highest quality at the best price, and then later down the track, build out that diversification piece within a self-managed super. Now, the reason I spent so much time answering Tom's question is because I thought it was a good one and I wanted to spend a bit of time on it. But also, I think a lot of people, much like the previous anonymous listener, I think a lot of people are going to be in this space where they've bought property over the last 5 to 10 years in regional locations, have done well, and they're now thinking, what's next? And, I don't want to destroy confidence or anything like that, but also you don't want to be too overconfident with investing, and just because something worked doesn't necessarily mean it's going to work forever. Okay, I'm going to squeeze in one more answer to the next question from Alf. Alf talks about, I'm just going to sort of summarize his question. He's asking a question about utilizing existing property investments that were owned pre-budget night that might be positively geared / debt free. So I think Alf probably has some investment property and how he's going to utilize it. Now, of course, someone that has, let's say someone that's got 2 investment properties that have no debt. So obviously they produce some taxable income. If that person then goes and buys a third property, they can offset the loss on that third property against the rental income on the 2 previously owned properties. So there is a little bit of a loophole there that really allows negative gearing for people that already have established significant wealth in property, which I think goes against the whole idea around intergenerational fairness and that. I mean, it's just a poorly constructed, it's nonsense, really. Because if the whole idea was to help people, well, all you're doing is actually making it really difficult for people that haven't got started in the property market and making it super easy for people that are already in a fantastic position. That's the complete revert to what you told us that you wanted to do. So it doesn't make sense. But what else also asking is, but what happens if we borrow against that equity? Well, if you borrow against the equity against existing property that were owned pre-budget night, it's the purpose for which you use that loan that determines, not the security. So if I borrow to invest in the share market, of course, that I can still negatively gear that investment because the negative gearing quarantine only relates to established residential property, not new property or shares. But if I borrow against the existing equity of those existing properties and buy an established property, again, that's still quarantined, but can be offset against existing rental income. So there's no way of changing the nature of the debt from that to get around the rules. But if you did have an investment property that was fully offset so that the loan was interest only and you had money in the offset account, what you could do is go and take the money out of the offset account and then go and buy another property and then gear that new property neutrally, for instance, because you put some cash into it, or at least you'd borrow the full cost and again put money in the offset against that new property. So, and then you can still claim full negative gearing on the property that you owned before budget night. So certainly this change in rules, tax laws, certainly highlights once again that loan structure and preserving flexibility within a loan structure. So using interest-only loans, putting cash in offset account, always borrowing the full cost of the purchase. These are some of the rules that we've been banging on about. That's why I wrote the book Rules of the Lending Game a few years ago, because loan structure is really incredibly important and then helps you navigate, or gives you at least some flexibility to navigate future taxation changes. So hopefully that answers your questions, Alf. Good questions, and thanks for submitting them. As I said, tomorrow I'm going to talk about a cash flow strategy that might help investors that want to go and buy established residential property to match the tax deduction, the timing of the tax deduction, knowing that, we have to carry forward quarantine rental losses with the timing of that tax deduction. So just a bit of a financing strategy that I want to talk through as a, potential option, whether you use it permanently or whether it's temporary. Depends on your situation, of course. Anyway, just a bit of a call out and reminder again. Sorry for beating you over the head with it, but really important to me that people don't make some crazy decisions with respect as a result of being targeted by property spruikers or FOMO or just making the wrong decision. So again, just as a reminder, as you're finishing listening to this episode, if you do know of anyone that kind of falls into that category and you want to help them, certainly share this episode and the previous ones that I've done, and maybe tomorrow's episode as well. That'd be greatly appreciated. But until tomorrow, bye for now. Okay, before I wrap up, just one favour to ask. If you got something out of today's episode, the best way to support the show is to leave a rating on Apple or Spotify or wherever you're listening. A couple of ways that I can help you in return. If you want to submit a question to the show, the email is in the show note. Also, we've got 3 downloadable guides, which you can download off our website. One's a very detailed report on how to choose the best super fund. We've got a debt recycling starter guide, and we've also got a decision tool to help you navigate the tax changes. And finally, if you haven't already grabbed a copy of my new book, Wealth by Design, it's out now, and it's got a very useful AI companion tool with it. Anyway, I'll leave it there, and thanks for listening. Until next time, bye for now.